The following is a presentation of TFNN. Live at TFNN, the Power Trading Hour, with your host, David White. Call now, toll free at 1-877-927-6648. Internationally at 727-445-1044. Now, David White.
And welcome all to another excellent edition of the Power Trading Hour with me, your humble, lovable, squeezably soft koala bear of Wall Street. No wolf here, just a lovable, cuddly teddy bear of Wall Street. On a day where we've had a little bit of action finally, at least intraday action. We were off 4 points on the S&P cash. We were off, 11 or 12 earlier this morning. A variety of reasons that you could attribute to that, and we'll talk about them today. As we start the show, of course, 1955 on the S&P cash, 1.76 billion shares on the New York Stock Exchange consolidated tape, and not a whole lot. Of course, we're getting ready to go into a shortened weekend next weekend. This week, it's all about putting out one good IPO and a ton of poor IPOs. Most of those have been either removed and or come out at the very bottom of the window of where they thought they would be bought. Of course, GoPro itself oversubscribed 20 times. So you could make a pretty good bet that it was going to bounce a little bit out there. Symbol on it now is GPRO. Take a quick look at that. See how it's doing. It pretty much opened at $28.75, somewhere around there, printing off at $31.25. Pushes this thing out to about $3.3 billion in valuation, which probably a little tough to swallow. But we'll keep an eye on that and others as we go through our trading hour. But first, we always like to start off with a little bit of histoire. On this day in 2000, in a joint press conference, Celera Genomics Group, the National Institutes of Health, U.S. Department of Energy, announced that they've completed the sequencing of the human genome, which should ultimately unlock the mysteries of human health and sickness. And, of course, a much larger story that led to a lot of companies that are now just really paying off fairly decently. So, what else do we have going on here? Just looking through some of the news out here. And, of course, one of the things that I wanted to be looking at is some of the news, especially toward technology. But what we did have before the bell was Samsung said its earnings quarter will not be all that good, that they've reached pretty much saturation on the very high end of the smart, or what they call super phones, the most expensive, the iPhone 5 or the Galaxy 5. And just not that many people willing to continue to upgrade every 6 months or a year. In Apple's case, of course, they have not had a bigger 5 or 6 inch phablet phone, and a lot of people are looking to that. But not a lot of movement in Apple either way. It was not a lot of range either out here also. But of course, up around that $94 level when it split, and back down here around the $90 level, just doesn't seem like there's a great deal of energy and a great willingness to go out on a limb, even all the incredible discussions about Apple later. And I have a feeling that, Apple will do okay. I'm not looking Apple to go back and bust through all-time highs anytime soon. It looks to me like they're going to, and I wrote about it extensively in the Tech Insider last week, more of the vacuum cleaner approach, which is they're not going to have any more customers for these super expensive phones. So they're going to start on the whole idea of selling attachments. Of course, Google's been talking about that. And just about everybody's got an iWatch of some kind already. Apple will be coming out with theirs supposedly this fall. Of course, just about everything and all these big companies are now trying to get at least their finger in the dike for all these new technologies. But to tell you the truth, it's very hard to see any of these things really moving well or getting any kind of momentum. In fact, the entire momentum trade's pretty much dead. Can't go up, can't go down, and we'll have to see how today closes out. But that we're not getting follow-through from yesterday suggests that we do have the kind of weakness that I think is inherent in the market. And we're going to need to be able to watch this closely. There's a couple of scenarios that I'm thinking about. One is that we do pull back a little bit over the next couple of days, maybe down to 1938 on the S&P cash, then see a nice slow drum back up maybe to 1950 or 1960 into the 3-day weekend of the 4th of July, setting up a opportunity in many of these charts for big and massive sell signals. We'll get into those later too, but I think pretty much we're very close. What else do we have? Okay. GoPro, of course, it did come out and is the proxy for the IPOs. This is the, we've got somebody calling. And let's go to Frank in Baton Rouge. How are you doing today, Frank?
I'm doing fine, David. I was wondering if you could look at Caterpillar Tractor and Con, CONN.
Okay, why don't we do CAT, since I've got a position in Con.
Okay. I'm also your one of your subscribers to your newsletter too.
Okay, why don't you email me on that with your questions, and we'll discuss that more privately.
Sure.
Okay, CAT. So what are you thinking about doing with CAT?
I have some puts on it. It's been very stubborn and declining despite 18 months of dropping sales and a global slowdown, but it won't give up in this game.
Yeah, this is kind of the whole scenario, though, that I'm talking about, and this is a good example. Are you watching on Tiger TV?
No, I don't have access to internet now.
Okay, you can watch it later, but any of these, there is kind of a pattern out here, and that pattern is a close below the 9-day moving average or the displaced moving average, either one of them, 3x3. The next close under that would probably signal a break on a great deal of stocks in the market, including Caterpillar. Now, you've had this light volume move back up into the marketplace, and it seems like we're waiting for something. I just don't know what that is. My guess is it comes in somewhere around the 4th of July weekend. So, we saw the pop down. I think we still have a range between now and a week from Friday of probably 1938 on the S&P cash to probably 1960. I'm going to watch today's close, but my guess is we close down 5-6 points today, probably 5-6 points tomorrow. Maybe see a bad Monday or Tuesday, and then start a kind of a slow pop up, and I mean slow and small, into that 3-day weekend. So this is summer trading where it is light. The volume naturally contracts. I know what you're talking about in Caterpillar. Everybody's saying everything's slower, and the market just won't give it up. But I have a feeling that a great deal of this is people chasing the last part of this market. There's not a lot of juice in it, especially when you look at it today. But I would say you're short CAT right now.
I have some options on it.
Puts?
Yeah.
Okay. I would say probably the next close under the 9-day moving average or the simple moving average or a displaced moving average. But you're right on it. When you watch this later, you're going to see this little line I have underneath it, and it is just above it. But any close back below that would signal a good opportunity to short. So I'm thinking I don't know how long you've had these puts, but probably just a little bit early.
Okay.
So are there Julys?
Yeah, I've been riding it kind of as it drags me along for the past couple of weeks.
But I mean, they're July 20th expirations, right?
Yeah.
Yeah. Okay. I think you're okay. The only thing is that you're probably going to get a little bit of bleed. I would say that probably, again, I'm going to watch what's happening at the end of the day. But my belief is that we're going to go down tag somewhere around that 1938, 1940 level, and then probably slowly go up. So if you would get that, that's probably where I would get out of them. Probably Monday or Tuesday is what I'm strategizing right now. And at that point, you want to probably come back and look at buying them on the Tuesday after we come back from the long weekend, and at the same time get some that are into August or something, move them out a little longer, because what we're probably going to see in a lot of these stocks, I suspect, is a long, slow bleed into September if the market does crack here. And I don't see a whole lot of energy, and I see so many stocks like this that are hanging out with no volume just above these moving average highs that normally show a crack and a pattern that I love very much called the 3x3 display. The double repo pattern from Joe DiNapoli. That's basically a long parabolic move. You close then for a little while under the 3x3 or the 9-day, then you close over it for a while, then you close under it. And if the market does turn south, these stocks run fairly quickly. On this case, you're probably going to run down to 100. I would just say that there's also probably better stocks than Caterpillar out here to probably short. It's not going to be a bad. How much are the options trading for right now?
Well, they keep a pretty good bit of premium on them, so they're keeping $1 plus premium on the close-end strikes. So
which strike do you have?
I have 109.
Okay, so you got 109. You got $1 in it. So, if you could get this thing to pull back down, probably I think if what's happening in the market happens, we probably see 106 in this, maybe Monday or Tuesday, a little bit of pullback. And if there's no volume in this market, that means that probably Wednesday, Thursday, and Friday we're going to have a light volume move back up, and all they're going to do is eat the premium on those puts. Now, if the market cracks totally, of course, you're just going to hang on to them. But my guess is that we're going to have, and normally you get this when a market really, because this market really is set up that if it does head down, and I'm going to get into it later, you could see a real tailspin in this market. But what you got to have is probably a big warning shot. And I mean, we're probably going to get, maybe a couple down to that 1938, get people worried, have a very, very, very light volume move back up. And that's going to be the warning and the chance for anybody long to get out. And they won't. And then they're going to walk in one morning and this thing's going to crack and you're going to be down on the downside. Anyway, thanks for the call, Frank. Email me with any questions on any stocks that are in my newsletters directly at TFNN.com.
Okay. Thanks, Danny.
Bye.
TFNN is excited about our new software charting program, The Art of Timing the Trade Charts. In collaboration with Tom O'Brien and using his best-selling book, The Art of Timing the Trade, Your Ultimate Trading Mastery System, David White has programmed an outstanding piece of software that will complement any trader's methodology. Using this first-of-its-kind program, The Art of Timing the Trade Charts allows you to scan thousands of stocks for Fibonacci formation setups, including Gartleys, ABCs, butterflies, and much more. The Art of Timing the Trade Charts is designed to help you when scouring the markets for stocks just beginning to form the trading patterns that many investors spend days, weeks, or even months searching to find. And right now, we're offering licenses available at only $79 a month. We are so confident that you're going to love this new charting software that will even give you a 30-day unconditional money-back guarantee. Don't miss out on this incredible new piece of software. Get your copy of The Art of Timing the Trade Charts today by visiting TFNN.com.
Wouldn't it be great if you could get a red light, green light indicator that gives you signals on 25 different future contracts? Now you can with Taz Signal Box. This red light, green light market profile system dynamically updates 24 hours a day and provides you with important trend and trade signals on 9 different commodities, 9 different indices, and 8 different currencies. Right now, you can receive a free 2-week trial to Taz Signal Box. For all the details and to find out how the signal box works, visit the front page of TFNN.com.
Andy Heck's powerful weekly newsletter, the Technomental Commodity Report, has delivered multiple triple-digit winning trades in recent months. And right now's the perfect time to get a full month-long trial to Andy's newsletter with no obligation to pay anything. Andy publishes his weekly newsletter every Thursday morning, where he breaks down the commodity market and provides his subscribers with specific trading recommendations based on his trading methodology. By signing up for a free trial to the Technomental Commodity Report, you'll get a full 30 days to try out this powerful newsletter service and see for yourself the types of trades Andy has recommended for his subscribers. When you sign up for a 30-day free trial, you're under no obligation to pay anything. And should you decide to continue, you'll lock in the low rate of only $59 a month. Sign up right now for the Technomental Commodity Report and make sure you're ready to catch the next big trade in commodities. For more information and to get started today, visit the front page of TFNN.com.
You've always taken the long view when it comes to investing, but what if there's an opportunity right under your nose? What if you could be more responsive to market trends to seek to boost your portfolio performance right now while seeking to reduce your overall risk? At Direction Funds, we connect investors with alternative strategies that seek to maximize their returns. Smart investors deserve smart alternatives. Find yours at directionfunds.com. An investor should consider the investment objectives, risk charges, and expenses of Direction Funds carefully before investing. The prospectus and summary prospectus contain this and other information about Direction Funds. To obtain a prospectus or summary prospectus, please contact the Direction Funds at 800-851-0511. The prospectus or summary prospectus should be read carefully before investing. Investing in index funds may be more volatile than investing in broadly diversified funds. Distributed by Rafferty Capital Markets, LLC.
Many of our new listeners have heard about the Tiger's Den, but wondered, what exactly is it? The Tiger's Den is a lively community where professional traders and investors can meet, exchange ideas and information in a comfortable, moderated atmosphere. Hear all of your favorite TFNN shows, plus see all the charts as they happen live during those shows, and have access to all those charts. You can test drive the Tiger's Den absolutely free for 30 days. It will greatly enrich your knowledge of these markets. Details on the Tiger's Den are on the front page of TFNN.com. Dave takes your phone calls now. Toll free at 1-877-927-6648. Internationally at 727-445-1044.
And as we come back, I had a question in the den, then we're going to get back to some snooze. The Cooper Company, COO. O-O-O? E-I-E-I-O? The Cooper Company, COO. Anyway, higher volume on the last high than the previous high. That suggests you're going to have a little back and fill and one more test at the top. Energy on this last leg was better than the last energy from April 11th up to May 12th. So I would say that there are probably better shorts out here. Ideally, you'd like to have this thing pull back maybe 132 back up to that 136, 137 level, and this time have very light volume. It's kind of hard for me to see any kind of upside or downside on this one. I just think there's better fish in the sea. Hard for me to say that this has a lot of momentum one way or the other. So I will say take a pass on that. There are better ones in the sea. Anyway, we're talking about GoPro before our wonderful caller called in. But what we have is GoPro looks to be a proxy for more IPOs coming out in the near future. And let's see, let me go back here and look. What do we have? Okay. Just wanted to look real quickly at the S&P off of 4.6 points, 1.85 billion shares. Just don't see a great deal happening. I saw a little kind of a fish hook in the S&P here on the more minute sides of the chart, just to see if there's anything going on. Anyway, it looks like it's an IPO that came out, 3.3 billion shares. It is a price like a Google or a Priceline or one of these companies with outrageous margins. It does not look like it is a a company that can continue those kind of margins. So I'm very interested in seeing how this trades over the next couple of weeks. It may have been good enough to suck the oxygen out for all the other 18 IPOs coming out this week, because almost all of them are either a few being pulled. Most of them are coming out at the very low end of the range. Anyway, we got Mike from Dallas. How you doing today, Mike?
I'm doing great. How are you today?
Fantastic.
Thank you for taking my call. David, I was wanting to ask you what your, interpretation of the Russell and the adding and subtracting of a lot of companies in the Russell, and do you think that it will still maintain its, enormous volatility?
The answer is yes. And basically what's happened is the stocks that ran the most are getting pared back in the overall formula, and the stocks that did the worst are getting ramped up. So the idea is that everything reverts to the mean, and that's how the Russell, pretty much their formula works. So if it's had a big run for a couple of years, it's probably being sold a bit by the Russell. And if it's had poor performance for a couple of years, it's probably being bought by the Russell, or added to, that. They're actually adding and subtracting, and you get that final posting of what's in it and what's out of it come Monday on the 30th.
Oh, okay, good.
But for the most part, it is, them moving a position like Apple, now that it's back up fairly decently, maybe they'll pull 10% out of what they have. And a stock that didn't do well, like, I don't know, a whole ton of them. Maybe they're out there buying Bed Bath and Below today. But, it's one of those stocks where what they do is a lot of the formula for the Russell's indexes are all reversion to the mean trades. They're all thinking stocks that get beat up will come back up, and stocks that are real high will come down.
Okay. Well, thank you very much for your analysis. That helps.
You bet.
Thank you.
Okay. Can you? Okay. Laughing out loud. Google one. Okay. Good one. Okay. Let's get back. Anyway, we're talking about GoPro, and the question is whether or not this thing can be valued. It is a consumer stock at the moment. They are advertising it as a media stock and or a stock like Google or Priceline or Apple that has 60% margins. Why they have very good margins for a consumer company, it is most likely that those margins will fall. This may be the sweet spot. And without additional products in different product sectors, this is one of the most risky IPOs and risky prices coming out at $3 billion. As we've said over the last week, not going to be real too tough for somebody like Samsung or Sanyo to get in here and buy one of these. You can give me a call at 877-927-6648. You can email me at path@tfnn.com, or you can post a message in the Tiger's Den, and I will answer it. Be back in just a minute.
Has the current market volatility continued to stop you out of trades when the market spikes against you? Now is the perfect time to open up an account with Nadex. Nadex, the North American Derivatives Exchange, is a brand new, completely regulated Chicago-based exchange, and unlike most other exchanges, Nadex allows you to trade directly through them with direct market access when using their completely free trading platform, which also features real-time charts and full customization capability. One of the advantages of trading with Nadex in volatile markets is that your risk is always capped, and you have the ability of keeping your trades open even when the market spikes against you. Nadex is completely brand new with a line of unique trading products that are unavailable anywhere else. See how it works at nadex.com. That's NADEX.com. Or click on the Nadex banner on the front page of TFNN.com. Futures and options trading involves risk and may not be appropriate for all investors.
If you're an active trader looking for that extra edge when it comes to trading and investments, then now is a great time to get a 2-week free trial to Tom O'Brien's daily market letter, Market Insights. Tom O'Brien's daily newsletter, Market Insights, comes out every market day at around 9:30 a.m. and provides Tom's daily commentary on the broad market, including the Dow, NASDAQ, and S&P, plus specific trade recommendations. There's even an update published most afternoons to keep you informed about the day's market activity. He'll give you the entry price, price target, and stop price of each stock and option trade. With Market Insights, there's nothing left to guessing. For all the details and to get your 2-week free trial to Market Insights started today, visit TFNN.com.
The Path of Least Resistance is David White's daily trading newsletter, and if you're looking for active trading ideas, then now's a perfect time for a 30-day free trial to this powerful daily trading advisory service. David uses his years of trading experience to offer his subscribers his trading ideas each morning in his Path of Least Resistance newsletter. Using a combination of equity trades along with options, David keeps his subscribers up to date with all pertinent market information with intraday afternoon updates when warranted. Don't miss out on this great chance to get a 30-day free trial to David's daily newsletter, The Path of Least Resistance, with no obligation to pay anything. David has been delivering solid recommendations for his subscribers recently, and if you'd like to see the type of newsletter he delivers every morning, then visit the front page of TFNN, and you'll find The Path of Least Resistance under Trading Newsletters. For all the details and to start your 30-day free trial today, log on to TFNN.com now.
No matter where you listen to TFNN programming, we want you to know you can always access your favorite shows on demand through TFNN.com. TFNN airs live programming every market day from 9 a.m. till 6 p.m. Eastern, and you can view each program by accessing Tiger TV through our homepage. We even have an easy link for all mobile devices, including iPhones and iPads, located at the top right-hand corner of the TFNN homepage. You can use your smartphone to view Tiger TV, but if you don't have a mobile connection that can keep up with streaming live video, then you can simply visit TFNN.mobi in the browser of your smartphone for live streaming audio of all of our programs. The mission of TFNN is to educate our audience directly and interactively through our interactive website and radio call and talk shows. TFNN is able to teach all levels of investors the technical skills needed to trade in today's marketplace. In order to get the best information possible, TFNN has assembled the most respected financial minds in the country to provide the most current news and comprehensive advice available. TFNN.com, educating investors. This segment is brought to you by Harmony Gold. For more information, just click the Harmony Gold banner on the front page of TFNN.com.
Had a quick question on HOV from the Den, and this came up right into the line of resistance that they came in on March 19th. 5.9 million shares. He had about that same volume here today, and maybe going to have a little bit more, but basically you're going to run into that huge line of support. So if you're along this thing, time to get out. And some of the news is not all that great in the housing sector, especially in England. We're going to get to that in a minute, but I just think that if you had a trade off the bottom on this thing, you had huge volume yesterday, big volume today, but I think that big volume runs right in to all this huge volume days down at 16.9 million shares, 9.8 million shares, and 7.7 million shares. And that's going to land you square into it, and probably why we have the candle we have today on HOV Hovinian. So not a lot in there. Okay, now back to this. Okay, we talked about GoPro, and we got a
red alert.
Oh, boy, that was loud. I got to turn that down. That was red alert, wasn't it?
Code red. Repeat. We are at code red. Repeat. We are at code red.
Well, they're at code red in England. They have sounded the alarm on the UK housing market. Central Bank this morning announced 2 lending rules and standards for mortgages in the UK with the goal of limiting the risks of financial stability in the economy from significant increases in the number of highly indebted households. Basically, they've had a lot of these properties, especially around London, going sky high, and they're looking to cut off a huge bubble over there. I think we're probably awful close to the same thing, if anybody would admit it, in at least two cities, probably New York, Manhattan area, and downtown New York, anywhere close to the Silicon Valley places where the housing levels are. If I could short them, I probably would. All it's going to take is some kind of massive change in how much cash is being pumped out there in Silicon Valley, and we're going to see probably the same thing we saw in 2000, which is a lot of empty places that you can get very cheaply. So just keep an eye on that. But I had a feeling that this was one of the reasons why the stock market kind of reacted a lot more this morning to the Fed's bullard, basically hawkish stance, which pretty much dropped this market fairly quickly, just a couple of minutes after the open. We were talking about value at risk. I wanted to get back to this before we get into charts, and we'll try to get into the last segment of charts. But I had a lot of emails about this yesterday and why I think this is a huge problem for stability in the markets. I talked about value at risk, and some people know what it is and some people don't. Value at risk is a model. It is a mathematical model. It tries to give you a probability as to a mark-to-market loss on a portfolio over a given time horizon that exceeds this value, assuming normal markets and no trading in the portfolio. Basically, this is the response to the 2007-2008 debacle, i.e., you don't know what your real risk is. Congress wanted some kind of model, knew that the CEO could not say he didn't know that he had this kind of risk. You want to be able to hit one button and see what was the value at risk in any particular one market or his entire portfolio. So it's a mathematical model. Now, basically what this mathematical model shows is as volatility falls, you can have more and more leverage. Whether you're a hedge fund, whether you're a big trader on Wall Street's floor, you need to be reporting this value at risk or another model that they approve. And that's part of Dodd-Frank. This is part of also the Basel Accords. Now, what this has done is made Wall Street very good at figuring out ways to kill volatility. The lower the volatility, the higher the leverage they can have, and the more money they can make. The problem is that it creates its own pitfalls. And that's where I'm kind of pointing at that I think we're, in a year from now, we're going to be talking about why the market blew up and at some time and had a huge downside that no one ever predicted. And my belief is that if you look at the chart out here of what value at risk sets up, basically the blue area is 95% of the curve, and that's a 1.82 standard deviation below the mean. So basically what they've done mathematically is set this up so that for 95% of the time, no matter what happens in the market, everybody's going to be fine. It's the last 5% that no one sees. Now, one of the problems is this thing really starts to tail out a lot higher than that 1.82. I look at it as a 1.5 standard deviation. So if we were to see some kind of standard deviation, I would say probably in the 1.5 area, which is not huge. One standard deviation is normal, right? What we haven't had is any kind of standard retracement. I'm thinking that at about 1.5, we would start seeing a lot of funds, hedge funds, street funds, having to dump stocks, especially the worst performing stocks, which means that they're only going to go down even farther as they search to get a value at risk model number that allows them to continue on and not have the Fed show up at their door and tell them they're out of business. Because basically we've enabled the Fed a great deal of leverage to put people in and out of business based on that. Banks and, of course, the SEC and actually the exchanges. But the government now has a pretty strong arm to go in and get rid of dead fruit. And that is the problem, is what happens when everybody hits or something happens and we all get back to that number, and suddenly at the close of business, they hit the button and it says they're over that value at risk model. This all works as long as volatility continues to go down. As volatility picks back up, the Fed, I think, would have to get involved in this market to make sure that the volatility never exceeds extreme levels. And so are they going to do anything other than slow down the inevitable? I'm thinking they will, but at the same time, a lot of times these kind of things come out of the blue and accelerate far beyond the ability for the Fed to get in front of them. So what my worry is that we do come in and we see one day a Dow that's down 1,000 points or so. Yeah, that they get involved in it probably, but it always seems like the Fed always takes a day or two or three or 2 weeks, and it always goes much, much farther than everybody thinks it could. And in this point, we not only have margin calls from on broker-dealers or hedge funds, but we're also going to have value at risk models that say that people are going to have to sell also, even if they don't have leverage. The selling will beget selling. And that everybody's basically on one model means that once we get to that level, everybody's going to be in the same boat. It's much better when you know that you don't have a market that everybody is long in, that everybody has the maximum amount of leverage because the volatility is long. Now, let's say that hedge funds got probably right now with a VIX in the 12 or 13s, probably going somewhere between 25 to 30 times long his cash for leverage. So if he's got $1 million, he's got $30 million worth of stock and or options. And of course, you know, if that pulls back, he may not only get from other people, he may not get that 30 times leverage anymore. It maybe drops to 20 times. But that still means that he's selling 10 times what a normal pullback would be if he wasn't leveraged. And that's where these huge pullbacks get massive amounts of acceleration. And it would be different if a lot of people had different portfolios. But basically what this sets up is a model in which the volatility or the VIX could kill an entire market by forcing everybody, whether or not they like it or not, back in to make sure that those value risk model numbers come out exactly what they need. So anyway, just a thought out there. You can give me a call at 877-927-6648. But I guess just my point is that we have a single model driving the entire marketplace instead of lots of different models where various people will sell at different levels. Most of these people are going to be very, very close to the same thing. And because of the low volatility, they're probably leveraged as high as they can go without the VIX dropping even lower. But it is part of the business of Wall Street, of course, to make money. And if they can continue to make this market go up 2, 3, 4 points a day, then they're great, because guess what? That means that they get to buy even more stocks. The stock goes up even more. And anybody that knows anything knows that that can't continue on forever. At some point, something will break that. And especially at these low values for volatility, and the belief that the Fed will stand in line with a Bernanke or a Yellen put anything is extremely dangerous. So that's why I think in a year or less, we'll be talking about this value at risk model being one of the major drivers in a pullback of extended selling that no one ever thought could happen. But just an idea, not happening in the next 5 minutes, but just something that we should be very aware of, that there could be a feedback loop that continues on because everybody's stuck with this one model. I think somebody uses another model, but I think it's less than 10% of the street, maybe 5% of the street. They all pick this model because, of course, it gives them more leverage. Yes, that's exactly right. Gives them a higher... Yes, okay. Just a few people echoing my comments in the den. Had a question from Rob. Wondering what your thoughts are for GILD for a short in the next couple of weeks. So let's take a look at GILD. Again, you can call in or email me at path@tfnn.com. Well, this thing's going sideways, not a lot of volume. And yeah, the one downside is, of course, this one gets a lot of news in Gilead Sciences. Probably the same thing, which I'm going to look at, is one more dip under. In fact, this is the exact model you want to be looking at. One more dip under the 3x3 or a 9-day moving average would probably have me short this stock. Let's just go back traditional. Yeah, I mean, you're right on it. That's exactly what I'm looking at in this market. That you get one more pullback underneath that 9-day moving average or 3x3 displaced, and you'd want to pull the trigger. So I'd be more willing to give this thing a little bit more room and just pull the trigger as soon as it comes below that. I like the 3x3 displaced moving average because it actually gives you actual numbers that you don't want to see this thing close under. And let's say closes tomorrow under $80.94. You already know that number with the displaced moving average because you're putting those numbers out in the future. $81.13 on the 30th. So we don't have a lot of room and downside in Gilead that would say go ahead and pull the trigger with this slightly lower closes, which is exactly what I'm looking at, and opens up that probably a run back to the about $74 level on this. So I think there are a lot of stocks that could probably blow up a lot worse than Gilead, but I see what you're looking at out here. But that's kind of the pattern that I'm seeing in a ton of stocks right now, is this sideward motion. It went above for a while. It's gone below it. It's come back above it now, and there's certainly no volume to the upside. The next click down below that 9-day moving average or 3x3 moving average would be that. And have another question on SLAB, SLAB. Whoop. Okay. This one's setting up a double repo also. I've been watching this. What you would love to see over the next couple of days is a close back up above the 3x3 displaced moving average. And the next close, I'd pull the trigger. I think you've got it here. Volume did increase today, not as much as it was yesterday. This is kind of the first signs that we're seeing a break in this. And we'll see where this thing would come back down to. Probably the $44 level, looks to me. And you've got that pretty much congestion zone, probably $45. So it'll probably be a fairly quick move. When's earnings out here? Let's take a quick look at earnings date for SLB. You got July 21st. So I think you got enough time. This market's going to pull back, and semi is going to pull back. We'll look at the SMHs when we come back. You can give me a call at 877-927-6648, 877-927-6648.
Daryl Martin coined the phrase diagnostic trading, and we're happy to announce that his diagnostic box spread analyzer has finally been released. The Diagnostic Box Spread Analyzer helps you easily identify the best box spreads on Nadex in seconds, plus you receive access to the diagnostic deviation levels, as well as step-by-step training videos teaching you how to trade Nadex spreads so you can quickly master the mechanics of this simple yet powerful trading instrument. By pulling live data from the Nadex exchange, the Diagnostic Box Spread Analyzer does all the math for you, calculating risk, reward potential, distance to break even for both outright spreads and spreads used to hedge the underlying market. Visit the front page of TFNN.com today to get your 2-week free trial to Daryl Martin's Diagnostic Box Spread Analyzer and gain access to the valuable information it can provide when trading the Nadex box spreads.
Tom O'Brien's weekly gold letter, The Gold Report, gives complete and concise coverage of the entire gold market. Inside, you'll get Tom's commentary on gold, the dollar, the rand, the bond, the XAU, the HUI, and detailed coverage of nearly 25 mining stocks. He'll give you the entry price, price target, and stop price of each stock trade. The Gold Report is a long-term newsletter where the focus is on building real wealth through the management of a successful portfolio of gold stocks. With a lifetime of knowledge and almost 12 years of writing his informative weekly newsletter, The Gold Report, Tom O'Brien can provide you with the important market information to help you make better trades in the gold market. Don't let the next bull run in gold pass you by. To get a month-long free trial to The Gold Report, an $85 value, visit the front page of TFNN.com today.
David White's newsletter, The Technology Insider, is focused like a laser on finding the next big things in technology. If you had invested only $10,000 in Microsoft in 1986, you'd have been a millionaire by 2000. Disruptive technology like Microsoft's is the key to these massive long-term profits, and the Tech Insider is the vehicle from TFNN to capitalize on these opportunities. This is the go-to newsletter that identifies, monitors, and profits on mostly little-known cutting-edge companies with great long-term prospects. David's experience is as an inventor of Emmy-winning animation products for TV and Hollywood that propelled a company public. Match that with 14 years as a full-time trader, and he's uniquely qualified to guide you through the light-speed world of ever-evolving high-tech. If you're ready to ride the next big technology bull market for less than $40 per month, log on to TFNN.com and get your 2-week free trial to the Technology Insider. Get in on the ground floor of the next big thing today.
We're told to follow our passion and everything else will fall into place. I hope that's what each of you are doing each and every day. Hi, I'm Steve Rhodes, host of the Money Master Show at TFNN.com, and my passion for technical analysis is what led me to the most fundamental discovery in pattern recognition, the Rhodes Momentum Indicator, market scanner, and trading strategy, a set of tools that identify the momentum and power of the trend, the likes of which have never been seen before, for every market and every time frame. Yes, folks, the trend is your friend, unless you're on the other side. New to technical analysis? This is the place to start. And experienced traders take advantage of the trend like never before. Experience the power of the Rhodes Momentum Indicator each day, available to subscribers of my newsletter service, Mastering Probability. I guarantee your satisfaction for the next 30 days unconditionally, so there's no risk to you other than being on the wrong side of the trend. Mastering Probability, available on the homepage of TFNN.com. And folks, live with passion.
Join Andy Hecht as he teaches you how to make money in commodities. The Commodities Hour, next on TFNN.
And the question in the den about Westport Innovations. Of course, this company converts regular gasoline engines into burning natural gas. A super high flyer, of course, in last year, this thing was up to July 1st last year, $35.40. It's come way off it, 50% off of it. It's back up to previous highs, a little lighter volume out here. This thing's probably going to have to consolidate between here and the $13 level for a while. Of course, we saw natural gas take a hit this morning. We've got Andy Heck probably going to cover that story later today, but a big buildup in natural gas. Probably not going to see any kind of huge drawdowns in that gas probably until probably in August, when we start seeing natural gas used as a lot of the coal plants have secondary nat gas plants that can turn on and off very quickly. And probably going to see that, but maybe a little dip. But to me, Westport Innovations is all about the story of getting natural gas stations along the interstates, and we've moved nowhere on that. Basically, you've got bus fleets, you've got anybody that can use vehicles in a known geographical area like a city that can be converted to it. Of course, if you take a Ford F-150, the conversion costs you $9,000. And the question is, how long does it take you? How much are you going to drive it? If it's a fleet vehicle that's out all day, probably makes sense if the price in your area of natural gas is correct. But the thing that I dislike about this, again, is just how long it takes to get that payback. And, the real story and the reason this thing was up at $35 is the same reason the solar stocks are all up there. Everybody wants it to be true. The problem is, fundamentally, how does it get there? And without probably the federal government mandating natural gas fillers on every gas station next to a interstate, I don't think that you get the kind of mass adoption that you want. There's lots of products out there, a lot of people looking at views of the future. But no one came to you with an iPad and told you that you were going to have to pay twice as much for it. Everybody just ran in and bought it. If it's such a hard decision to make, it is a very hard business to live through. And that is the problem. Do you pay $9,000 now and wait for 2-3 years to get the payback? And a lot of cities will do that. A lot of companies will not. It makes this quarter look bad. And until you can get a better risk-reward payback, it's going to be problematic. Now, we've seen T. Boone Pickens talk about his gas plan. It's probably right. The problem is none of it's being implemented. And Westport Innovations basically needs, for a bigger growth story, the kind of discussion that is national in nature. And right now, I can just say that this current administration hates all energy of all kinds other than solar. Maybe wind. But even then, it's hitting birds. Solar is the only thing that they like. Let me put it that way, as far as I can tell. And other than that, it is problematic. So maybe we get a new president, maybe a new Senate drives forward natural gas and, of course, the associated pipelines to move that natural gas across the country and to more places. One of the things natural gas really needs is pipelines. And, of course, pipelines very difficult in rocky areas to put underground. Down here, fairly easy. Anyway, we'll see you tomorrow. Same bat channel, same bat time. We'll be in the studio with Tom O'Brien for the Tech Insider Hour in the 4 o'clock hour. Until then, sell when you can, not when you have to, and hang on for Andy.
Since 1984, Basil Chapman has been using the Chapman Wave methodology to advise traders of his expert market opinion. While originally hand-drawing charts from the late 1970s into the 1980s, Basil noticed that prices under most circumstances virtually always had a certain number of legs to the upside before declining sharply. Later, Basil found that computer software, which included the standard market technical indicators, enhanced the degree of accuracy in calling price turns, as well as market trend calls. Thus was born the Chapman Wave sequence. Using the Chapman Wave methodology along with other indicators, Basil Chapman advises his subscribers of his expert market opinion each market day with his opening call newsletter. Right now, you can get a 2-week free trial to the opening call, Basil's daily trading newsletter, by visiting the front page of TFNN.com. Cancel at any time during that trial and pay absolutely nothing. Get your 2-week free trial to Basil's newsletter, The Opening Call, today by visiting TFNN.com.
You're watching Tiger TV.